Hi guys, it's Kevin Kleinman. You know me as the founder of Watchhimtrade.com, but what you probably don't know is that I'm also an investment manager for a firm called Blue Haven Capital. And what you also probably don't know is I've made more money off of long-term investing than I have off of short-term trades. That's why I want to make sure each and every one of my followers understands the benefits of long-term investing and doesn't overlook it when considering how they want to participate in the stock market. The first thing to understand about long-term investing is that historically, the longer you hold an investment, the more you increase your future earnings potential. If you had invested $5,000 in the S&P 500 40 years ago in 1977, your investment is worth over $140,000 today. You might say, okay, who cares? That was 40 years ago. Well, doesn't it make you wonder what $5,000 invested today might be worth in another 40 years? And what if I told you that all it took to turn that $5,000 into $140,000 over 40 years was an annualized return of 8.72%? Well, your next question might be, what is an annualized return? An annualized return is the compounded rate of return earned on an investment over a given time period. Annualized return is a very important term to understand when discussing the advantages of long-term investing. Here's an example to help you understand annualized return. And note that these are just random numbers being used for example purposes. Let's say we start with a $10,000 investment and we earn hypothetical returns of 10%, 5%, minus 7%, 11%, and 13% over 5 years. Well, after 5 years, our $10,000 investment is now worth $13,473. This equates to an annualized return of 6.14%. And the annualized return equation is at the bottom of this slide, and it's posted in the description of this video. The key takeaway with annualized returns is that they include the effect of compounding. And the only way to earn a compounded rate of return is to reinvest your earnings. In our example, after we made $1,000 in year one, we reinvested it so our new account value was $11,000. This way, in year two, we make 5% on an $11,000 investment instead of making it on a $10,000 investment again. If you take your profits out each year instead of reinvesting them, you're not going to make as much money off of positive returns. In our example, if we didn't reinvest our earnings from year one, we'll make $50 less in year two. Now that might not look like a lot when you take it in the context of this example, but with real dollars in real years, you can end up missing out on a fortune over the long term. This graph shows the importance of reinvesting your earnings to earn a compounded return. The blue line represents an account that reinvested their profits each year and generated a compounded return. And the red line represents an account that did not reinvest their profits. In this example, the $10,000 investment that reinvested their profits each year is worth nearly $135,000 after 30 years. That's just with one single $10,000 investment at the beginning. Due to the compounded return, they end up with nearly $135,000 after 30 years. The other account, which didn't reinvest their profits each year, isn't even worth $40,000. We're talking about a difference of almost $100,000. Notice too that as more time goes on, the effect of reinvesting your profits pays off more and more. You might be thinking, long-term investing works great when the market's going up, but what's it going to do when the market goes down? Well, historically speaking, we know two things. Number one, it is extremely hard to time the market and know when it is about to go down. Number two, reducing your exposure after a down year is usually not a wise decision. The reason for this is the long-term opportunity cost. This graph shows a $10,000 investment earning 8.73% per year that experiences an 11% drop in year 4 of the investment timeline. The blue line represents an account that stays fully invested and rides out the 11% drop. The red line shows an account that reduces their exposure after the drop because they are fearful of a continued market downturn. Most importantly, the green line shows the opportunity cost of this decision by the red account. Notice that by year 15, the red account is making $3,500 less per year than the blue account. Of course, this is just a hypothetical example, but our point is that it is very hard to time the market, and we think you are best off staying invested and holding through the ups and downs. If anything, we would likely recommend contributing new money to the market to help reduce your cost basis at an opportune time. It's very, very hard to know what the stock market will do on a week-to-week or a month-to-month basis, but historically over time the market has gone up. Take the financial crisis of 2008, for example. If you bought stocks just before the financial crisis and you're still holding, you've actually made 9% per year and you had doubled your money by the end of 2017. But if you sold any time between 2009 and 2012, you ended up losing money. And if markets do go down, historically speaking, it's been a good decision to buy into that weakness for the long term. That's why contributing new money to your portfolio is so important. It gives you a chance to increase your market exposure at opportune times. This chart really shows the importance of contributing new money to the market each year, or at least every so often. In this example, we're modeling an annualized return of 5% per year for 30 years. The blue line shows your account value if you contribute $5,500 to the account every year. At the end of 30 years, you'll end up with an account value of nearly $400,000. The red line shows your account value if you contribute $5,500 every 4 years. At the end of 30 years, you'll end up with an account value of $110,000. The green line shows your account value if you only contribute $5,500 in year 1 and then never do so again. At the end of 30 years, you'll end up with an account value of just $23,700. Obviously, we all want to be up in that $400,000 category, but if we can't contribute new money each year, still look at how much of an advantage you have if you can contribute at least every few years. By contributing regularly to your retirement account, you can increase your chances of having a much larger nest egg when you're at retirement age. In summary, here are 4 keys to successful long-term investing. Invest early on in your life, even if it's only with a small amount of money at first. Stay invested. Don't try to time the market. Reinvest your earnings so you can earn compounded rates of return, and contribute new money along the way so you can take advantage of market downturns. We realize how popular it is to try and outperform the S&P 500. However, studies have shown that there is no predictability to beating the S&P 500 on a consistent basis. This suggests that the average long-term investor may be best off by simply accepting the yearly return the S&P 500 is providing rather than trying to exceed it. And if you want to invest in the S&P 500 for the long term, it's really easy. 2 ETFs, SPY and VOO, SPY and VOO, will mirror the performance of the S&P 500. They're excellent low-cost options for an investor that wants a simple way to invest in the S&P 500 for the long term. By buying one of these, you ensure that if the S&P 500 goes up 8% over the course of 10 years, so too will your portfolio. Now, we're not saying that by investing in the stock market you'll be able to buy a mansion or a Lamborghini, but it can certainly help you provide a nice life for you and your family. So don't ignore the possibility of making 8 to 10% per year on your money. Over time, those are real dollars that can help pay off your mortgage, property taxes, college tuition, and other major expenses that come up throughout your life. We know that day trading beats long-term investing in a popularity contest. But we also know that most people who try to day trade are not profitable. Chances are if you've tried day trading for yourself, you probably haven't been consistently profitable from the time you started. And that's okay. But don't let it turn you off to the benefits of long-term investing overall. Understand that short-term trading and long-term investing are two totally different things with very different rates of success. If you'd like to learn more about some of our philosophies or what services we provide, you can email, text, or call. Let me know what you thought of the video in the comments. Any feedback you have would be much appreciated. Thanks for watching.